Welcome to the ABF Journal Podcast. Today, we're joined by two veterans of the real estate restructuring world. With a track record that includes major projects for companies like ITT, Dress Barn, Pet Value, and Kenneth Cole, our guests specialize in unlocking hidden value from both leased and owned real estate, especially in distress. In this episode, we will explore how lenders can use strategic real estate planning to minimize risk, avoid unnecessary court filings, and create liquidity. From sales scenarios to lease restructuring, we cover what works, what doesn't, and what lenders need to know to stay ahead. Let's get into it. Hi, everyone. I'm Rita Garwood, Editor-in-Chief of ABF Journal. I have two guests joining me on the podcast today, and I will let them introduce themselves. Andy, would you like to go first?
Sure. Hi, everyone. Thanks for joining. I'm Andy Graiser. I'm one of the co-founders here with my partner, Emilio Amendola. For those that don't know A&G, our company focuses specifically on real estate. Types of real estate that we get involved in are both fee and leasehold properties. We get involved in working with our clients in making sure that whatever real estate they have, or whether it's fee or leaseholds, we also are able to assist with rent reductions, lease terminations, subleasing, etc. And again, this is important to note, is that we do this both in court and out of court, which is really going to be an important part of our conversation today.
Great. And Emilio, would you like to introduce yourself?
Hi, Emilio Amendola, also a co-founder of A&G Real Estate Partners. Andy and I have been partners since 1991. Prior to A&G, we had a company called DJM Realty. And we've been doing this and helping companies, both retail, office, and other companies restructure their real estate.
So can you walk us through how A&G supports lenders from a property valuation all the way through to the sale or lease restructuring, and how that full life cycle of service mitigates risk and creates critical short-term and long-term liquidity?
Sure. Why don't I take that one? We usually approached, and a lease restructuring project is very different than a sale project. I'll just cover a sale project for this conversation. The earlier, we get involved in a project, the better. It allows us to go through. Typically, when a lender approaches us, they ask us to give them valuations of properties, and it's usually, the right way to do it is to value it, assuming the property's marketed on a normal marketing basis. Sometimes, lenders come and ask us to evaluate real estate and say, how much can you get if you were to sell it within a 3-month period of time, within a 6-month period of time, and what the actual, if you took your time, what the value was. And there's a difference in valuations between, marketing it in the ordinary course and marketing it in an expedited fashion. Perfect example. We did a project a number of years ago for ITT. It involved the sale of 32 properties in 15 states. And, we were asked to put together a model. It was early on in the process. It was actually before it went into receivership. We were asked to put together, a model that was able to sell all 32 properties, allowed the company to repay its debt within a certain period of time, and which ones we thought would sell first and which ones would be the longest to sell. And, if you market it in an expedited fashion, and we were presented offers right away for, $40 or $50 million for this batch of assets. Our recommendation, because of the diligence we did prior in evaluating each piece of real estate and determining a plan for each one, we suggested that rather than selling it in an expedited fashion, if you took your time and did it the way we suggested, that there would be a much greater recovery. And it wound up, at the end of the day, we recovered $92 million versus the $40 or $50 million that might have been achieved if you did it in an expedited fashion. You need to understand the real estate and what you're selling, and then design a plan around what you're selling.
And on the restructuring side, this again just keeps going down to the real estate optimization and trying to see exactly what the right opportunity is for each lease or each fee-owned property. Emilio covered the fee-owned property side of it. And on the lease side of it, look, I mean, there's certainly everyone talks about is it below market, is it above market lease? And that's how a lot of people look at real estate. And the reality is it's not just always about a below market rate lease here. I mean, there's a lot of other things that go into the understanding the real estate and where the greatest opportunity is on restructuring it. And it could be some some nuggets or nuances within the lease which allows you to get, that has a lot of lease exclusives that might be could be valuable to the landlord and not so valuable to you as a tenant anymore. There could be some no build zones that might have been important when you did a lease that are now valuable today. There may be excess parking, which we see a lot of. When we did movie theaters, we saw a lot of excess parking that created real opportunities to really get some good rent reductions there. You can imagine when you're going into stadiums seating, that type of, the number of people that can go to a theater is going to be a lot less, which means your requirements for parking are a lot less. So there's nuggets within the in the leases, and there's also nuggets within the market. You can have barriers of entry where in some cases you might even be above market. That creates candidly a good opportunity here as well, just because maybe a replacement tenant might be able to take over the store as is, where is, and start creating EBITDA right off the bat. And for purposes of the landlord, there's also going to be opportunities for them to also work with a tenant in place and instead of spending real capital dollars to try to replace them. So there's a real benefit here for the landlords to work with the tenants as well.
So Andy, you kind of hinted to this initially, but there's a lot of conversation around in-court restructurings. We cover it all the time at ABF Journal. But what should lenders understand about how much can be accomplished outside of the Chapter 11 process?
Sure. And there's really two ways to look at this. One is just an orderly wind down of the company. That's one. And just by way of example, we've done this for companies like Dress Barn. We've done it for Charming Shops. We've done it for Good Guys. And so it's sort of the list goes on. And we've done these in the form of, and also Pet Value is another good example as well. And this is where we were doing lease terminations outside of a Chapter 11. And what we did candidly is, in that particular situation, put a certain amount of dollars at our side that the company could afford to pay to terminate the real estate, provide an opportunity for landlords to get more than what they would get in a Chapter 11, and provide them really good information so they can, do their due diligence to make sure that the recovery we're talking about was fair and reasonable. And again, more than what you would get in a Chapter 11. In those out-of-court situations, you need professionals. You need law firms. You need you need the financial advisors to do the work and support the solicitation that you're going to be doing with landlords, especially in a wind down scenario. We've done, in part of the wind down scenarios, we've also done composition agreements, which is effectively a bankruptcy outside of a bankruptcy, where the creditors had their own set of professionals, the company had their set of professionals, provided lots of data, due diligence, and actually even formed a small committee of creditors here that they were able to review and look at the information. And once they did that, they were able to then go to the other creditors here that were impaired, and let them know that there was due diligence that was done. Professionals corroborated the recovery and the information and allowed this to be done more in and out of court. And that was again sort of an important step. And I'll bring up that composition agreement because I think there's more opportunities to do that today. Then obviously you have the other scenarios where you're trying to do an out of court, where you're also going to be an operating entity at the end of the day. We've done that for companies like Kenneth Cole and others, SMCP. And that scenario, again, you need to bring in professionals, make sure that you're being fully transparent, just like a composition agreement. You're showing the business plan, you're showing the liquidity, you're showing, the different, cash flow models, you're showing what the company's going to look like going forward here. You're providing even copies of forbearance agreements. You're providing copies of borrowing bases, et cetera, to make sure that all these creditors are really comfortable that what you're saying is actually accurate and it's being backed up with professionals that have done the work. The waterfall that's important as part of that type of transaction, is where you're basically showing the landlords that they're going to be better off outside of a Chapter 11 than inside. And even if you show a 20 or 25-cent recovery of what an unsecured claim would be, that's still better than what they would normally get, because a lot of these cases, generally unsecured creditors get zero. So that is, it's important, not easy to do. There's a lot of boxes you have to check, because the capital structure and the debt structure really sort of drives what you can or cannot do here, and to make sure there's also liquidity available to do some of these lease terminations. And at the same time, making sure that you're not throwing good money after bad. So sometimes it is important to make sure that the money going out the door, you get to at least like a 90% recovery, a 90% indication of interest from the landlords that they would accept this deal before you allow money to go out the door. And that, again, protects the lenders for allowing the company to throw good money after bad. So, Emilio, I don't know if you wanted to cover any.
Yeah, just a few things. I think what's important is planning. Plan in advance. Know what you're going to go out with. Understand exactly what you want to accomplish. I think full transparency is the key here. You need to be able to demonstrate to the landlords the reasons why. And the only way you can describe the reasons why is by providing all the detail that they need in order to make an informed decision. And everybody really needs to participate. I don't mean only the landlords. There's what the landlords don't want to feel like is that they're the only stop on a train. You need to demonstrate to them that, that the company's participating, it's cut its expenses as much as it can. The vendors are helping by providing, whatever the vendors provide. It needs to be an all-inclusive. And the more you plan and the more transparent you are, the better chance of a successful outcome. And you're making payments to creditors rather than professionals.
So going back to that conversation about managing professional fees in particularly a Chapter 11 scenario, you already started talking about this, Andy, before, but can you share a specific example where an out-of-court lease restructuring significantly helped a lender or borrower avoid a costly bankruptcy scenario?
Yeah, I think a couple of good examples was when we were involved with Kenneth Cole, when we were involved, just the companies that we talked about. It was Pet Value is one, Dress Barn, although that ended up going into bankruptcy, but had nothing to do with the real estate piece of it. And then, the Charming Shops was a good example as well, where you were able to unwind the entire company, terminate leases at, a fraction of what the lease liability was here, and based on a percent of what a bankruptcy claim would be. And in that case, you looked at the dollars that were spent doing that transaction versus the amount of dollars spent on the professionals. It clearly was a much bigger savings, and it saved, and candidly, it saved the lenders a lot of heartache and headaches going through a bankruptcy, which we know is really time consuming, which a lot of lenders just don't have these days. And again, I'll mention one thing, not easy to do. There's a lot of things that go into seeing if it actually has the actual makeup that can work through an out-of-court setting. But if you can sort of check all those boxes, it's worth going down that road, because you could always pivot into a Chapter 11.
So you started us off by talking about, the valuation and due diligence that you do for clients. What makes that especially critical in today's asset-based lending environment, particularly for lenders that are assessing recoveries or providing additional liquidity to their customers?
Look, it's important for lenders to understand exactly what their potential recovery would be. And when we're approached, right, we're asked, what do we get out of this if we sell it in a 3-month, 6-month, 9-month period of time? And as long as you understand exactly, but they can lend against those values. They want to know if the house burns down, what am I going to get out of this? If the company really goes bad, what am I going to get out of this thing, and how quick am I going to get out? And if you give that bottom case, it can only get better from there. But I think what's important is, before you get started in the analysis, you really have to understand what you're selling. Not every asset needs to be sold a certain way. There's some folks that are out there that just like to put it in an auction. Sometimes the auction isn't the right way to go. Sometimes it's better you market a property in the ordinary course versus an auction, right? If you have a special purpose asset, take a college campus. If you have a college campus, you have a lender that's lending against a college campus. There's not a whole lot of alternatives, and there may be one or two buyers, that might be interested in it. If you go out and put it in an auction, the chances of somebody showing up at the auction are going to be slim, right? So understanding the asset, knowing what the recovery would be, and knowing who your target audience is really going to help you in value. And that's what, the lenders look to us for in terms of, us providing them with diligence and values on properties. They use it to really lend, at the right levels.
So speaking of that, how are lenders using your valuation metrics and analysis to guide their underwriting or their restructuring decisions in today's market? And with so little new developments happening, especially outside of residential, have you seen that help strengthen valuations?
Yeah, I mean, I think that certainly in retail, the less development that's happening today, some of the older properties now becoming more, valuable simply because there's no new development. There's a lack of new development, or not as much development as the demand. And so, what used to be a property that might have been considered a B property becomes very attractive because there isn't a whole lot of property available for companies to acquire or get into. And so, the values get stronger as there's less supply that comes out in the market. So I think the less supply that's coming out in the market is really has helped values.
And what are you seeing in terms of recovery trends across property types, office, retail, industrial, and how are those impacting your valuations and sales process?
Well, I mean, at least in the values that we prepare, based on, a fairly quick sale, we're achieving values and usually exceeding the values that we put on it. Again, understanding the property, understanding how to sell it, and who your target market's going to be really helps you in terms of getting the values you need to get.
Yeah, I think what helps a lot here is the fact that we have spent so much time educating different prospects on real estate and how to buy it in some of these distressed situations. And I think what's happening is more and more players are coming to the table, and as they start getting their feet wet here and seeing what a great opportunity is to take over a location, and within 3 or 4 months you're up and running and creating EBITDA. It just really for every time we're running a project, it seems like more and more of these companies are starting to step up and wanting to buy this real estate because there's just no new development out in the market, and that really has helped our sales trends quite a bit.
So real estate assets in distressed situations often come with challenges such as deferred maintenance. How does your team navigate challenges like that and still deliver strong results for lenders?
It's create competition, educate the buyer. Anytime we get involved in a project, we like to, provide the third-party reports. We like to tell people the condition of the property. There's a third party that goes in, gives you a property condition report. In a project we're doing now, we're also providing a zoning report in case you want to redevelop the property into something else. A new survey, an updated title. It just, if you got to have an educated buyer, right? They're gonna see, and you provide them with the information. They're gonna see that there's value there, and they should acquire it. And amazing what happens when you have competition. When you have two parties that want to buy the same asset, sometimes the value gets a heck of a lot higher than you expect. And so I think competition creates value, and they'll overlook some of these things.
How do you create competitive sale environments like that in the middle market that help maximize value even in distressed situations? Is it possible to create it, or is it just a naturally occurring thing?
No, you need to, once you understand the asset and who your target is, you know exactly, who you need to go after. And I'll give you a perfect example. It was a hard to sell asset, but it was a warehouse, a growing facility, a greenhouse down in Paris, Kentucky. And it's a 2 million square foot building. And we needed to find the right buyer. We thought, because of the type of facility it was a hemp farm. that it wasn't made for a vegetable grower, it would be a flower grower. So what did? We went to the top 100 flower growers in the United States, and we targeted that as our market. We then went to other parts of North America, into Canada and Mexico, to see who might. We wound up finding a flower grower out of Canada that wanted a facility in the area. They had a facility in Chicago. They wanted to get something where they own. We put it under contract at $22 million. Well, we continued the marketing. We found another company out of California, another public company, large public company, that came in and they, competitively bid, and all of a sudden, this thing went from 22 million to 34 million. And the recovery to the banks went from, less than a certain percent to almost 100%. And, it's knowing your buyer, knowing your market, and attacking it and that's how you create competition. And it's all you need is two parties in the same business that want that project, and that's what drives value. You need to create the competition. You create the competition by knowing who your buyer is and going after and get two players in the same business.
Well, that was all the questions that I had for you. Anything else that you would add? Anything we missed that you think is important, or any final thoughts?
Yeah, just a couple, just one point I just wanted to raise it, because again, with the lenders, I think it's important that when an out of court gets brought up, that they are really asking sort of all the right questions here, because again, this is somewhat not normal today. However, there used to be, probably 15 years ago, out of courts were more normal, but now we're kind of entering into a new world here. And I think the key here is always making sure that you're avoiding good money going after bad, thinking about escrow accounts and trust accounts that you can put dollars aside in to settle unsecured creditors, because that will create a lot of that could certainly create a lot of credibility to a process. And I would ask about that. I'd also making sure that as you're looking at these out of court situations, you're normally seeing companies getting really late in rents, and you want to make sure that the company's got a process in place to manage their defaults, and that the defaults are being cured properly. Otherwise, you could be at risk of having a store or warehouse terminated, or even worse, where you have it locked out. I think it's also important just to understand the timelines here. The key here is, with any of these out of courts, you want to keep it on a short leash. So if you needed to pivot, you could pivot to a Chapter 11 relatively easily. So again, those are some things just to keep in mind. But again, it's the amount of liquidity that can be created in these situations by avoiding a lot of extra professional fees, et cetera, could be a really good opportunity for the lenders.
If I could just add, what you should do, plan what you're doing, plan in advance. Don't let the crisis take over. You need to plan. You need to understand, what you're trying to accomplish and the time in which you need to accomplish it. And if you're selling an asset, understand the type of asset that it is, and don't fit that asset sale into a process that you have. Design a process around the type of asset that you're selling. Everything doesn't fit in the same way. You can't just throw something into an auction. Understand what you're selling and create a process around it, and not the reverse.
Well, thank you both, Andy and Emilio. It was great talking with you today. Thanks for being on the podcast.
Thank you.
Thank you.